Estimated taxes are simple in concept. The IRS expects you to pay tax as you earn income, even if no employer is withholding for you. The penalty happens when payments arrive late or are too small. You usually need estimated taxes when income isn't automatically withheld, like self-employment income, gig work, investment income, rental income, or retirement withdrawals that don't have withholding set up. The first thing to get right is the quarterly schedule. For 2026 estimated taxes, the standard due dates are April 15, 2026, June 15, 2026, September 15, 2026, and January 15, 2027. These aren't every 3 months the way people assume. The IRS uses specific payment periods, and the due dates are fixed around those periods, which is why June comes quickly. Now the core question: how much should you pay each quarter? The clean starting point is Form 104 OES 2026, which walks you through estimating your tax and dividing it into installments. If you want the simplest penalty avoidance approach, learn one phrase: safe harbor. You can often avoid the underpayment penalty if you pay at least 90% of the tax you owe for the current year, or 100% of the tax shown on your prior year return, whichever is less. If your prior year AGI was above the IRS threshold, the prior year safe harbor can become 110% instead of 100%. That safe harbor rule is powerful because it lets you avoid penalties without predicting your exact year-end income perfectly. It turns the problem into a math target. Here's where people get trapped. Income doesn't always arrive evenly. Investors may have capital gains in one quarter. Business owners may earn more in busy months. Retirees may take a large distribution late in the year. If your income is uneven, the IRS allows methods that align payments to when income happened, often using annualized income concepts and Form 2210 mechanics, which can reduce penalties when payments match the timing of income. Now, let's make the process practical. Step 1. Estimate your total income for 2026. Step 2. Estimate your total tax using 104 OES. Step 3. Compare your plan to Safe Harbor so you know whether you're protected. Step 4. Choose a payment method. Many people use online IRS payment methods or the 1040 vouchers and keep a proof of payment. The important habit is saving confirmation numbers and dates. If you're a retiree, there is a key simplifier. Withholding from certain payments can be treated as if it were paid evenly throughout the year, which can help reduce penalty risk when done correctly. That's why some retirees use withholding adjustments instead of quarterly payments when income spikes later. Finally, do a quick quarterly check-in habit after each quarter. Compare your actual income to your estimate and adjust the next payment. Estimated taxes are not about one perfect calculation. They're about making sure you don't drift too far off target. When you understand the due dates, the 104 OES estimate, and safe harbor protection, quarterly taxes become a routine instead of a penalty surprise.